From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Farrow. Bloomberg Real Yield starts right now. Coming up, a sovereign debt bubble starting to burst. Central banks ramping up their fight against inflation, pushing investors away from risk and nearly everything else. We begin with the big issue, the global bond rout intensifying.
Bond prices are down.
Two-year yields flying.
If you look at what's going on in the UK this morning, this is EM-like.
Relative to bonds, relative to treasuries, it's actually still pretty orderly.
We have weakness across the world.
I think we're going to see more damage ahead.
4% yield in the 2-year or something approaching 375 in the 10.
That's a pretty good place to sit for a while.
Yields are becoming attractive.
Positive long-term opportunity in fixed income.
I'm short everywhere. So I'm short 30-year treasuries, I'm short 20-year treasuries, I'm short Italian bonds, I'm short bonds.
It's been an exceptionally painful period.
This is an exceptional period of time to be hosting Real Yield because there is real yield on a positive level in a way that we have not seen since 2009. Joining us now is Nuveen's Tony Rodriguez, MUFG's George Goncalves, and Meghan Graper of Barclays. George, I want to start with you. We're looking right now at perhaps one of the biggest resets in the bond market in modern history. Is there a sovereign debt bubble that is bursting?
Lisa, I've been thinking about this for decades, really. Since 2008, ultimately the end game we have to ask ourselves would always end up at the doorsteps of the sovereigns. And I think, the low rates for longer, the policies we had through QE globally, again, this is not just a U.S. phenomenon. I think this is the pendulum swinging the other way.
Do you agree, Meghan?
Yeah, I mean, I don't think there's a lot of new information in so much as that it's not a real surprise that across the board policymakers have been determined to tame inflation. I think what has become more glaring this week in particular is just sort of this perceived need to capitalize on what's likely to be a fleeting opportunity to advance some of these more restrictive policies while the labor market remains tight and before economic contraction becomes too far entrenched. So I think the picture being depicted with this massive recalibration we're seeing is one of a market that finally seems to be paying attention. And I think recognizing that the chances of a soft landing have greatly diminished.
Quickly, Meghan, does that mean that you think that the time in which this bear market has to run is limited and that we're going to reverse?
I think it's not wholly surprising in the context of the G10 narrative this week that risk assets have fallen as sharply as they have. I think at the end of the day, this relentless rise in rates that continues to play out again here today. You have a 2-year having risen close to 65 basis points since CPI, 10 years higher by 35 basis points. It's 30 basis points of flattening as investors try to reassess the path of this hiking cycle. And yet, I think in our eyes, the yield curve is still not sufficiently pricing in downside risk. If you look at the front end in particular, I think we are still underestimating sort of risk of more restrictive policy ahead, meaning, I think it'd be a mistake to interpret the dots in the U.S. as the ceiling. So while 4.5 or 4 3/4 is the 2023 policy rate, might only speak to net 25 basis points of hikes next year. I don't think at this stage we can rule out more hikes in 2023 and a higher peak rate at the end of the day.
All right, there's a lot to dig through. Tony, I want to bring you in here. Do you agree that this week perhaps is a bit of a reality check for markets, but wasn't a huge recalibration on the parts of central bankers and on the parts of many of the policymakers around the world?
Well, Lisa, hi, good to be with you. I do think that what we're seeing basically all this year is a bursting of the monetary policy bubble of zero rates, low inflation, QE. So the market has reset. I think as we sit here today and we've seen this sharp move just in the last week or two, we are starting to get pretty close to where I'd say we're pricing in anywhere from 90% of the overall move when we think about the rate structure. We do think this is going to slow the economy down. We're seeing that obviously already in the housing market. We've seen it in certain industries, FedEx warnings, et cetera. So we do think that as further tightening happens over the balance of this year, we're going to start to see that slow down. So we think we'll see some further inversion. The 2-year can go higher from here, but we do think the 10-year is likely to be at a fair value level right now and will, we think, be lower as we move into the middle and later parts of next year in response to that slowdown in the economy.
So both of you are flicking, and I'd love to bring you in, George, on this as well, flicking at this question of capitulation. When have we seen full capitulation? Bank of America's Michael Hartnett weighing in on the recent bond rout, writing, quote, that the great bond bear market in bonds is thus far a doozy. Losses on course for the worst since 1949, 1931, and 1920. The bond crash threatens credit events and liquidations of the world's most crowded trades. True capitulation is when investors sell what they love and own. George, why is it that we have not seen greater widening in credit spreads? Is this basically what that's speaking to, that people still love this stuff, they still own it, and they aren't willing to part with it just yet?
Look, people still are viewing this through the rates channel. I mean, they haven't really embraced the idea that if we're going to have a slowdown next year, then delinquencies and defaults can pick up too. And this idea that we're going to have, if we're not going to have a soft landing, this is a rate shock, and we really think the Fed's going to go well north and get close to 5%. Good luck. I mean, you're going to see some serious damage to the economy. It's going to happen fast. And I think, the IG investors are in denial if they think that somehow they're going to escape that. And really, we haven't seen the correlation risk yet of markets going to one. This is going to start off slowly. We're turning up the heat on the financial conditions tightening. I think it's still early. It's still at the beginning. I think this is going to continue till the next Fed meeting, the Fed minutes, and then we have the midterms, and then we have next year to deal with. So I think this is early innings for all this tightening.
And there's a question of how this really translates into the Treasury curve. Meghan, you were speaking about this, and just to bring you a sense from Bob Michael of JP Morgan Asset Management coming out and talking about how the Treasury curve could potentially get that much more inverted, just like you were saying. Let's take a listen.
We think at a minimum, the Treasury curve will be at about 4.5%. That's a 12% yield with credit spread and where the Treasury curve is. That's substantially above the 8.5% now. So there's a lot of impatience in the market to take advantage of the repricing. We're not even in the recession yet. Let's wait till we get there.
So, Meghan, you talk and you work all day on investment grade credit. How much more widening could you see based on positioning, based on the weakness in the macro environment, but offset by that strong position of balance sheet by a lot of corporates?
Yeah, I mean, from where I sit, I think there's a growing bifurcation and this clear disconnect between reactions we're seeing in equity and credit markets over the last week. And I think it's just trying to reassess some of these risk paradigms. So I think despite some of the moves you've seen on equities and rates, if you look at what's playing out in the U.S. corporate index, which is a $6.5 trillion index, we've only seen a basis point of widening this week in the midst of what's happening all around us. So, and we're still 20 basis points off the year-to-date highs. So most are pointing to the 5.25 yield on the index, which is a 13-year high, is the primary driver of that outperformance. We have seen that fueling a bid from both fast and real money buyers that are trying to step into those types of levels. Many of them are investors that had been well positioned for this. So they're sitting in cash and looking for entry points. We see evidence of that in trace activity yesterday. The street was net lifted on $500 million of debt across the curve. It's maybe not surprising. It's most pronounced in the belly of the curve. So 7 to 12-year maturities, I think, continue to outperform here, just given 30-year treasuries have been much more contained in this recent uptick. But, that's happening at a time when investment grade is being met with issuers that are incredibly restrained. So there's a backlog of borrowers who've been closely monitoring the market. But we've still seen only $78 billion of investment grade issuance, which is half of what we had expected heading into the month of September. And it's putting us at risk of seeing the first September in a decade to fall short of triple-digit supply. So there is, this move towards higher yields at a time when the market is underwhelming in terms of new issuance due to just borrowers who don't want to try to navigate the volatility. And I think it has nothing to do with, lack of accessibility or a lack of a bid, given how much cash is in the system, but rather, an ability to sort of sit back and ride out some of the storm as we look at these intraday swings and the market tries to wrap its brain around the path ahead. So I still see opportunities in IG. I think it's just much more selective in the way you need to be involved.
As we're talking, we're looking at a rapidly changing market, rapidly selling off in equities, but in the FX market, complete transformation. I'm looking at the pound getting decimated, falling the most going back to March of 2020. Former Treasury Secretary Larry Summers blasting the new economic policies in the United Kingdom. telling Bloomberg, quote, "I think the UK is behaving a bit like an emerging market, turning itself into a submerging market," and really looking at some of the pain that some of the tax cuts and spending plans have wrought. From your perspective, Tony, how much is this a catalytic event? Is a crisis that has wider ripple effects through broader markets, especially as institutional international investors don't have the same power to come into the U.S. market?
Yeah, well, we're definitely carefully watching the currency markets. As I mentioned before, that's one of the asset classes that's really almost been in a bubble bursting type of mode with, low teens to 20% type negative returns for major currencies. The disconnect between now very stimulative monetary policy, fiscal policy and tightening monetary policy is going to be difficult for that economy to reconcile and deal with the energy crisis, et cetera. So we think the stories of the dollar is going to remain strong here through the balance of this year, whether it's from a rate differential, growth prospects, or just flight to quality in a high volatility, highly uncertain environment. The dollar has a lot going for it. And so the risk is that you do see some financial dislocations that exist as a result of that weakness across all really major and developing market currencies.
Tony Rodriguez, George Goncalves, Meghan Graper, all of you are sticking with us. Coming up, we're going to be looking at the auction block, a host of global rate decisions keeping U.S. borrowers on the sidelines, just as Meghan was saying. That conversation coming up next. This is Bloomberg. This is Bloomberg Real Yield. I'm Lisa Abramowicz in for Jonathan Farrow. Time now for the auction block, where we kick things off in Europe. Sovereign sales leading the charge in primary markets. Offerings from Austria and Spain helping issuance top 28 billion euros this week. In the U.S., 5 high-grade issuers coming to market Thursday alone, boosting sales to $6 billion, but still falling well short of weekly estimates. And Royal Caribbean breathing some life into the high-yield primary market, becoming just the 5th company to sell U.S. junk bonds this September. Sticking with credit, former Goldman Sachs partner Abby Joseph Cohen forecasting more pain to come. Take a listen.
The damage that we've seen in the bond market, I think it was expected. When we look at government bonds, it's one thing. The damage in the credit markets is something that we've not yet seen fully rolled forward because a lot of those are illiquid securities. And I think we're going to see more damage ahead.
Tony Rodriguez, George Goncalves, and Meghan Graper still with us. George, what's your perspective on how much more there is in terms of credit spreads pricing in some of the downturn that other areas are forecasting?
Well, let me be clear on one thing. We can pick on or focus on IG, but the real problems are going to be in high yield and most likely in middle market loans and more on the fringe than anything else. I'm not so concerned about IG from the greater kind of perspective. I think 20 to 30 bips wider, and I think we're going to surpass the wides we saw in the early part of the summer. But I do think that the bigger focus should be on high yield and these other kind of fringe markets.
Okay, so what's the threshold between paying some of the wides that we saw earlier this year versus something more protracted, something that becomes, George, more of a credit crisis?
Well, it really comes down to liquidity, right? At the end of the day, we're all trading in some form liquidity risk. And so far, there's large cash hoards and a lot of money in high quality paper, and there's really no forced selling or need to sell. I think when and if we do get to that point, considering the sort of volatility we're seeing in markets, I'm more concerned about you get this kind of correlation of one and you sell what you can, and IG is what you can sell at some point along with treasuries. So I think that's the risk that really lies ahead.
Tony, from a medium-term level, you are looking at credit as an opportunity. What divides the medium term from the short term? What has to happen in the medium term for you to get more bullish, to be buying more aggressively in the credit sphere?
Sure. Right now, we think that you definitely want to be very careful and avoid the CCC area, low single B. You want to be higher quality. We think the default rates will hold up. We like the liquidity and balance sheet strength in those companies. But we do think spreads are going to widen here over the balance of the year until we get to the point where the economic weakness is now more obvious to the broader market and to the Fed, and the Fed can begin to respond to that by slowing down the tightening cycle. We do think the economic hit will be strong enough that we won't see a 5 to 5.5% terminal funds rate. It's more likely to be in the 4 3/4 to 5 area. And once you get to that point, we think the liquidity on the balance sheets, the lack of the need to refinance high levels of debt in the high yield market, and at that point being priced for defaults in the 5 to 6% area will represent a pretty reasonable opportunity with close to double-digit yields.
Well, definitely yield seems to be much more prevalent now than it has been in decades, potentially. Meghan, from your perspective, I know there is appetite for investment grade. A lot of people seeing opportunity there. What about internationally? I mean, we started by talking about the debt sales in Europe, in addition to some of the pain being felt in the United Kingdom. How concerned are you about the creditworthiness of companies in the Eurozone, in the UK?
Yeah, I mean, the challenge for investment grade on both sides of the pond right now is that we continue to be data dependent. And so, it's been the upside to that is it's been insulatory for the credit markets because supply has been as manageable as it has as issuers try to navigate sort of data induced volatility. But you're seeing an ability to diversify while technicals remain as strong as they do, while that supply demand imbalance is still intact. So much so that we're bringing U.S. corporates. We did a deal, $3.5 billion euro transaction for Medtronic recently with broad-based receptivity. We had a $14 billion order book, I believe, for that transaction. So there's no shortage of cash and liquidity looking for opportunities to step in Europe as well. And it's global asset managers being able to play across currencies where they see value. So for the time being, I think that creates, discipline in the market. Nobody's oversaturating any given market because they can diversify across currencies. I think on the longer term, the road ahead is going to continue to be challenging for risk. And while IG remains more insulated, I think we are sort of keeping a close eye on does the shoe first drop in Europe in terms of starting to see fundamentals, which have clearly peaked, starting to trend lower. And while I think leverage remains reasonably in good shape on both sides of the pond, the headwinds, whether it be FX or inventories, are undoubtedly going to start pressuring margins. We've seen some early signs of that, and I think Europe probably more exposed on that count. And so as you look down the road, that could start to translate to potential downgrades. I don't think that's something that plays out in the U.S. until we're well into 2023. I think Europe probably more exposed to that being a scenario to monitor as we move into the fourth quarter. And the way you can, as an investor, try to evaluate that is looking where the rating agencies have credit on negative watch, and there's 175 billion of debt currently with negative watch in the investment grade market, and they're arguably the most exposed. And the resolution to that tends to be 40 to 60% of them, likely resulting to downgrades. So there's 110 billion of near-term potential debt at risk. If you talk to our strategists at Barclays, we continue to think you need to go up in quality and remain internationally diversified to try to navigate around that.
George, from your vantage point, not just from a credit fundamentals point of view, but also from an investor pool perspective, how concerning is it in places like Japan and some of the currency devaluation that they're trying to control? Perhaps we will see what success they can have. And then the United Kingdom, how much does that create a more fraught backdrop for investment in U.S. credit? Since, for example, Japanese once were some of the biggest investors in these spaces in the world.
That's a really good point. And one of the things that I'm really concerned about from this asset allocation and global diversification standpoint, which obviously works when really financial conditions are very favorable. But when we're in an environment like we are now, like local markets, I think people are going to hunker down and stay to their own jurisdictions, and you're going to see more local buying of your own local debt. And that's going to be true for the U.S. as well. I mean, I think we're this domestication of this kind of bond market and moving away from a global bond market to more local kind of flows. I think it's going to be something we're going to have to deal with. And the U.S. really benefited tremendously for years from overseas activity. I think that's going to be drying up for at least the time being.
Tony, final thought?
Well, there's certainly no more local buying that exists than the BOJ with the 10-year in Japan. So there's definitely a lot of local buying that's going to happen there. We do think that the QE reversal here to QT is part of this whole rate repricing. And so you're going to have to attract international investors. Ultimately, we think the U.S. has done a pretty good job of pricing that in with the levels that we've reached here post this last couple of days of move.
Do you have any idea, George, of when it might be safe to invest in the United Kingdom?
I really don't have a really good call on the UK right now. I don't think anyone really does. I mean, the pound's moving way too fast. This is, markets are all kind of collapsing towards one on the FX side. I think there's more of a concern about the FX more so than the actual underlying credits. But I mean, obviously you can try to hedge some of those things, but I would probably stay away from the UK right now.
Tony Rodriguez, George Goncalves, Meghan Graper, everyone sticking with us as we look at true real yield, with the 2-year yield crawling up to nearly 4.2%, the highest going back to 2007. Still ahead, the final spread the week ahead, featuring another busy slate of Fed Speak, starring Chair Powell. That conversation coming up next. This is Bloomberg. This is Bloomberg Real Yield. I'm Lisa Abramowicz in for Jonathan Farrow. Time now for the final spread the week ahead. Coming up, a host of Fed officials speaking throughout the week, with Chair Powell taking center stage on Tuesday and Wednesday. Plus, we'll get new U.S. home sales, consumer confidence numbers, and then U.S. GDP on Thursday. Finally, rounding out the week with, yes, that's right, University of Michigan sentiment survey and Eurozone CPI numbers on Friday. It will be a University of Michigan sentiment kind of Friday. Tony Rodriguez, George Goncalves, and Meghan Graper still with us. It is time for the rapid fire, and it is a really important rapid fire at a time when people are not getting their head around what even the levels are. So the first question is, what's the more likely peak in the Fed funds rate, 5% or 4%? Tony?
5.
George?
4.
Meghan?
5.
All right. What do you think will outperform over the next 12 months, U.S. investment grade or U.S. high yield bonds? Meghan?
U.S. investment grade.
George?
IG.
Tony?
High yield.
Wow. All right. And then at the end of next year, how big will the Fed's balance sheet be? Will it be closer to $7 trillion, or will it be closer to where it is right now of $8.8 trillion? George?
Somewhere in the middle.
Tony?
7.
Meghan?
I'll take this low end, 7.
All right. My thanks to all of you. Tony Rodriguez, George Goncalves, and Meghan Graper from New York. That does it for us. Same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg.